Hi everyone, and thank you for joining me. Today I would like to briefly cover two things. Firstly, the recent performance of the global equity component within the Northstar Global Flexible Fund, and second, the launch of our Northstar Global Equity Fund, which became available as a standalone equity fund on the 1st of December 2025. Importantly, this new global equity fund replicates exactly the same equity portfolio that has existed inside the Global Flexible Fund for over a decade. In other words, while the fund itself is new, the underlying strategy and track record are well established. As we enter 2026, it is useful to reflect on what was a volatile year for equity markets in 2025. We saw sharp sell-offs early in the year around AI-related disruption fears, followed by tariff-driven weakness in April. In both cases, markets reacted quickly, the concerns proved less severe than initially feared, and equities recovered to reach new highs. This reinforces a key principle of our investment approach at Northstar. We invest using a bottom-up, fundamentals-driven process, guided by valuation and conviction, rather than reacting to short-term market noise. Despite the volatility, several themes were clear during 2025. Emerging markets, up 33.6%, outperformed developed markets, which returned 21.1%. And most major developed markets outperformed the US, with Europe, the UK and Japan all delivering strong returns, and performance was a positive across all 11 equity sectors. Against this backdrop, our global equity strategy performed well. In the fourth quarter of 2025, Northstar Global Equities returned 5.77%, outperforming the MSCI World at 3.21% and generating alpha of 2.55%. For the full year, the strategy delivered 23.57%, ahead of the MSCI World at 21.66%, generating alpha of 1.9%. From a positioning perspective, the fund remains underweight the US and overweight Europe, with exposure to markets such as the UK, Netherlands, Denmark and Sweden, where we continue to see attractive long-term opportunities. Looking ahead, we believe the combination of fiscal support, monetary policy flexibility and regulatory easing should remain supportive for equity markets. While elevated valuations and geopolitics remain important risks, the portfolio is therefore positioned defensively, with our buy list currently forecasting low to mid-teen returns. I'd like to thank you again for your continued support, and for more detail, please visit our website.